Good day. Today we are going to talk about value-added tax. I will start by introducing, giving you the definition of value-added tax. Value-added tax is an indirect tax on consumption levied at every stage of importation, manufacturing, distribution, wholesaling, and consumption. The main purpose for value-added tax is the revenue generation. It's just looking for money by governments, and it's a very good and efficient system which helps nations to raise as much money as they need to finance their activities as government. It is generally in Zimbabwe, it is governed by the Value-Added Tax Act, Chapter 2312. And it replaced mainly the Sales Tax Act, because we used to have sales tax as a tax which was on consumption, but it had its own weaknesses as a tax system, in that people could evade it so easily, and it was also discriminatory. And also, if I was registered for sales tax purposes, I would not pay tax when I'm buying from the wholesaler, because the assumption will be I'm buying for retailing. So what will happen is many of my friends and relatives will buy their items for consumption through me, because they will know by so doing they will escape from sales tax. And that is not the same case with value-added tax. In that value-added tax, whether you are registered for VAT purposes or not, when you are buying something which is VATable, then you have to pay the VAT upfront. And if you are registered, meaning if you are buying for the purpose of business and for the purpose of retailing, then you will be able to claim the VAT that you are charged by your suppliers. So at least with value-added tax, it is neutral. Everyone who acquires or buys something that is valuable, they have to pay the VAT applicable on that commodity or on that service. And the one who is registered can then claim it. The one who is not registered cannot claim it. It becomes part of his cost of operations or cost of the commodity. So value-added tax is good because of that. It is efficient because of that. And also the good thing is, with value-added tax, if someone is registered for value-added tax purposes and is charged VAT, they can claim that VAT. So there is an incentive for record keeping, and you have to keep your records for tax purposes for 6 years. So for VAT, you have to keep your tax invoices for 6 years, and these are the invoices that you get from your suppliers. So each and every invoice that you claim input tax from government, you have to keep it, because at any point in time before 6 years, the expiry of 6 years, ZIMRA is entitled to come and make an audit on your VAT return, and they would want to have a look at your VAT file. So there is an incentive for you to keep invoices, because those invoices you then can claim VAT from Zimbabwe Revenue Authority, and you'll be refunded on that basis. Then also another advantage is that it spreads the tax base. It spreads the tax base, in that government does not have to wait until the final consumer consumes the commodity, but at every stage in the value chain of the commodity, government can get something. Meaning, if the manufacturer manufactures the commodity, there is VAT element in that transaction. Then when the manufacturer sells to the wholesaler, there is VAT element which is paid to government. And then when the retailer buys from the wholesaler, there is VAT element. And then when the retailer finally sells the commodity to the final consumer, then there is also VAT. So at every stage of that value chain system, government will be getting something, and they'll be able to keep afloat. So one of the advantages arising from that is called tax buoyancy. Tax buoyancy. So there's tax buoyancy, meaning In other words, this it means keeping afloat. Keeping afloat. So we are saying it helps the government to be kept afloat in that they don't have to wait until the final consumer acquires the commodity, the commodity for consumption. But at every stage in the development, in the value chain of the commodity, government will be getting something out of it. So in Zimbabwe, value-added tax was introduced on 1 January 2004. And it replaced, like I alluded to, sales tax. It also replaced Gaming and Gambling Act. It also replaced the import tax. It replaced partially stamp duty, because stamp duty for commercial papers is still there, but for some other items it was replaced to have VAT as the main tax that is left on that service or the consumption of that good. What are the main characteristics of VAT? Number one, it is a tax on consumption. When you are buying for consumption, then there is VAT. Number two, there is it is a multi-stage collection of tax, meaning what I've alluded to, whenever there is a transaction, even before the final consumer finally acquires the commodity, there is VAT there. Then it is charged on the value that is added. And in some cases, there may not be any value added to the commodity, but the value added might be the markup on the commodity. So generally, those are the main characteristics of value-added tax. How then do we determine the VAT payable or refundable? I'll illustrate here on the board. So we are saying output tax, and this one is related to sales less, so I can have some X's there, I'm sure you can see them, less input tax, and this is related to your purchases. So we less that, then we get our VAT payable or refundable. So a refundable normally arises in cases where during a certain tax period you purchased more than you sold. So you have more tax invoices from your suppliers than the invoices or the sales that you have made to your consumers. So in that case, then you give a VAT refundable. So VAT is managed or administered on monthly basis. So for every month we are saying how much sales have you made and how much VAT did you levy on behalf of government in those sales. So the VAT which you left is the one that we are interested in. Then when you were trading during the course of the month, you were also making some purchases of goods or services, and we are saying how much VAT were you charged by your suppliers, and we take that part of the VAT which you were charged by your suppliers, and then we say output tax, then less the input tax that you were charged, and then we get the VAT. If we have more of output tax, then we have a VAT payable, and if we have more of input tax, then we have a VAT refundable, meaning you can claim that money from government because you would have paid more VAT to your suppliers than the VAT that you collected on behalf of government. Then other key terms that I want you to master if you are dealing with VAT. VAT is a very simple topic, but the challenges comes especially if you fail to pick these two terms which I am going to demonstrate here.